I'm starting with Module C. So today is the next class of Module C, and I'm starting with the area of JAIIB ratio analysis. Ratio analysis is under Module C. Earlier, it was a part of Module A, one of the chapters which is super duper important from the point of view of the examination. Why? Because this is always asked in the examination. Not only in this, you will find it in different examinations as well. This is a part of the bank promotion examination as well. So that means if you are looking forward towards Module C, it is there at every single level of your examination. Okay, so then when we look forward towards the chapter of ratios, ratios is what? Ratios is basically relationship of one thing with the other thing, right? One particular thing, relationship with the other particular numerical part. Okay, starting with the first question. A few of the questions today are discussed from the IIPF book itself. As I've told you earlier as well, that I am covering the questions completely from the IIPF book plus additional questions, past year questions, and the questions which have been asked in different examinations from this chapter. Right? So since this is a part of different examinations as well. So overall, what am I covering? If I look forward towards the particular preparation, I am covering IIBF book, I am covering the JIB previous year questions, I am covering the questions which are important and which can come in the examination. As well as my focus is towards understanding the conceptual area. That means if you understand the concept, then you will never be scared what kind of question you are going to have, because you are not focusing on the question, you are focusing on the concept. Right? So here comes the first question, everyone. First of all, they talk about accounting ratios helps in. What does the accounting ratio help in, everyone? What's the basic purpose of accounting ratios? The basic purpose of accounting ratios is that it is a part of the interfirm comparison. It is basically intrafirm or comparison within the industry norms, or all of the above. When we talk about accounting ratios is something which includes everything. That means it includes all of these. It allows interfirm comparison, that is comparison within the firm. Then intra means within two firms you can compare, and it also helps you to compare with the industry norms as well. So it is completely covering all of these together, right? Okay. Next question. DSCR, that is called debt service coverage ratio, in which of the following is used in which of the following? Judging the margin of safety available, that is the default in repaying the loan. Judging whether the firm has borrowing disproportionate to its net worth. Judging the capacity of the firm to service the interest on debt, or all of the above. Debt service coverage ratio is basically covered under the solvency ratios. This particular ratio is related to the area whether this is actually a very judgmental ratio. As I told you, the entire these are basically interest coverage ratio, debt service coverage ratio. These are covered under solvency only. But see, these ratios are so judgmental that whether you can pay back or not, is it worth it to give you money or not, they talk about this. So in this case, what's going to be the correct answer? In this case, we are looking forward towards the fact whether the margin of safety available before there is default in repaying the loan. We would like to know what is the amount that they have and what is the permanent amount they will have to pay. That is fixed amount they will have to pay every year if they take a loan. Next point, everyone. Which one of the following is true? Among the following, which one is true, everyone? I hope it is visible now. Go ahead and answer. It says both EPS and price earnings ratio vary with the stock market. While calculating debt equity ratio, fixed deposits from shareholders are taken as a part of debt. While calculating quick ratio, all current liabilities are not taken into account. Debtor turnover ratio is higher if the company sells more goods on credit basis than on cash basis. What would be the answer? So what would be the answer in this case, everyone? Let's look at it. Both EPS and PE ratio vary with stock market. Yeah, they are market price. They are based upon. They are called market test ratios. But EPS is not based upon the market. PE ratio is based upon the market. Now, the next point is fixed deposits taken while calculating debt equity ratio. Debt equity would simply mean that it includes debt, that is long-term debt, and equity, which is a form of the money which is given by the shareholder himself. But fixed deposits from the shareholders, that means they have given a kind of loan to the organization. Fixed deposits means long-term, more than 1 year. It should be taken as a part of debt. Yes, this one's true. While calculating quick ratio, all current liabilities are not taken. It is taken into account. This is wrong. Debtor turnover ratio is higher if the company sells more goods than on cash basis. No. There's only one correct. As debt upon equity can be stated as this is the long-term debt and this is the owner's capital. This includes owner's funds. Owner's funds, that includes equity plus preference plus reserves and surplus. Okay? Which one of the following is true? Higher debt equity ratio increases the profit margin. Debt equity ratio is an indicator of solvency. A high current ratio is always an indicator of efficient management. Depreciation is not an expense, should be excluded while calculating profitability ratio. Depreciation is a very strong expense. This is how people had been looking forward towards the tax planning. This is wrong. This one's completely wrong. High current ratio is an indicator of efficient management. No. High current ratio means you're keeping so much funds liquid. Why are we keeping so much funds? So much amount of funds liquid. What's the benefit? What would I do by keeping 10,000, 12,000 in my pocket every single day? If my business requirements is barely 2 to 3,000 max. If I'm keeping a lot of money in my liquid area, I could have invested this money into RDs, FDs, or even in, if I save a lot and then I put it in the real estate. The organizations have been doing this. They've been putting it into mutual funds, real estates, even the infrastructure investments. That is way better. What are they doing by keeping it in their hands? This is not a good point. Debt equity ratio is an indicator of solvency. This is true. It's a part of solvency, and that too long term, not short term. So we have got the answer. Then comes higher debt equity ratio increases the profit margin. No, higher debt equity means we have taken way too much of debt. More debt means our interest rate would be more. If interest expenses more, our profit would be less. Because if expenses increases, our profit falls. So it is B. Next point. Which one of the following statements is correct about fixed asset ratio? What's true, everyone? It is a ratio of fixed assets upon net worth, fixed assets upon long term. A ratio less than 1 indicates that short-term resources have been diverted for fixed assets, or none of the above. There is only one thing correct, that is fixed assets is divided by long-term funds. Fixed asset ratio. Okay? This is FA upon long-term funds, or I can say the total capital employed. Next point. No, this is only for long-term funds only. Overall, the long-term funds. Net worth is basically your equity share capital plus preference share capital plus reserves. Next ratio. Current ratio is liquid assets upon current, fixed assets upon current upon current liabilities, and liquid assets upon current liabilities. What would be the correct answer, everyone? Current assets is CA upon CL, which is expressed in the form of ratio. The ideal debt equity ratio is 2:1. In terms of books, it is 2:1. In practical life, it is 1.33:1. If you have if you have to pay 1 rupee, you should keep it max 1.33, not more than that. The answer is current assets upon current liabilities. So this is current ratio. If I'm looking for quick ratio, it is going to be quick assets upon current liabilities, where quick assets is current assets minus inventory minus prepaid expenses. Done? Done, everyone? I hope you're noting down. One particular secret of this particular topic is that you note down all the important information, because what happens is people do not note down the formulas in terms of ratios, and they think that we can learn it that way. Overall, you will have to learn it. Without learning it, you cannot solve the questions, and to learn it, you will have to jot down all the formulas. Okay? That's one of the secret of this particular chapter. Here comes the first question, that is a numerical based question. Cash balance is given, trade balance is given, then we are given with inventory, then we are given with trade payables and bank OD along with current ratio. You have to find the current ratio there. For current ratio, it is going to be CA upon CL. Our current assets are 15,000 of cash balance. Trade receivables are of 35,000. Inventory is of 40,000. That's it. Why? Because trade payable is given. The money which I owe to someone else, that would be divided. That is 24,000 plus 6,000. What would be the answer, everyone? Sorry, it's gonna be 90,000 divided by 30. This turns out to be 3:1. The current ratio is specified in absolute ratio form. So 3:1 is the absolute ratio form. Done? It is 3:1. Next question. This is a measure of liquidity which excludes generally the least liquid asset. Current ratio, account receivable. Liquid ratio, account receivable. Current ratio, inventory. Liquid ratio, inventory. What is the measure of liquidity which excludes generally the least liquid assets? That is liquid ratio. But liquid ratio records accounts receivable because we can pressurize a debtor. No, you need to give me money right away. Bill receivable can be pressurized, debtors can be pressurized, but you cannot pressurize and sell off your entire inventory, even if you try very hard, right? Until or unless you go on a loss, you will not be able to sell these things. So liquid ratio, inventory. So in this case, the correct answer is liquid ratio inventory. Liquid ratio or liquid assets do not include, from the current asset you have to remove inventory as well as the, what was the second point everyone? It was prepaid expenses. Done? On the basis of the following data, the cost of revenue from operations by the company will be opening inventory. Opening is given 70,000. Closing is given 80. Closing is given 80. So what is the average everyone? 70 plus 80 divided by 2 will give us 75,000. This is my average. So now if I use the formula, I'm writing it here everyone. ITR is equal to COGS divided by average stock. This is 6 is equal to COGS divided by 75,000. That gives me COGS is equal to 75,000 multiplied by 6. It gives me rupees 4,50,000. Done everyone. So this would be the answer. Okay, now moving on to the next question, that is 4,50,000. How do we use it? This is called inventory turnover ratio. Inventory turnover ratio can be specified as COGS, that is cost of goods sold, divided by average stock, where the formula for average stock is opening stock plus closing stock divided by 2. This is the formula that we use. By using this formula, we are taking up the COGS as well as the average stock. What is the formula for average COGS everyone? This is the cost of the goods that are sold in the market. Opening stock plus purchase plus direct expenses minus closing stock. Done? Okay. These are the formulas that I've used. In this case, they had given with ITR and they had given the average stock. So we could multiply and find the value of COGS is equal to ITR multiplied by average stock. Then the cost of revenue from operations. Cost of revenue from operations. Revenue from operations means sales. So what is the cost? Revenue from operations minus profit. Revenue from operations minus GP. Revenue from operations minus closing inventory, or purchases minus closing inventory. If we are looking forward towards cost, our gross profit or the production based profit is always your selling price minus your cost price, SP minus CP. That would be revenue from operations minus GP. This is your, if you want to find the cost price, it is SP minus GP. Enough? So here revenue from operations is specified as sales. This is the net sales of the organization everyone. Okay? So in this case the correct answer would be revenue from operations minus GP. I hope you have got the answer everyone. Please keep an eye on it. Please check it out. And this is it for the day everyone. Okay, I hope you know that our JAIIB physical books are also out. The PPP book as well as the AFM book has been recently launched. So one thing that you can do is you can check out the details of the same on our website or in our app. Okay, so let's move on and let me show you the app there. What you need to do is you need to go onto our website, that is www.adda247.com. Go on to the website, go on to the lower area, click on the area of JAIIB and CIB. Here you will find the JAIIB CIB Mahapack. Mahapacks are good because if you are preparing both JAIIB as well as CIB, under JAIIB you will get everything of JAIIB. Mock test, test series, revision batch, current batches, previous batches, recorded batches, live, be it bilingual, be it English medium, whatever has been done in the new syllabus, each and everything is opened up for you, be it JIB or be it even CIB, that would be all covered. So you can take up the JIB Mahapack as well. Double